Listen, sorry to interrupt, but it really is important for us. If you can just hit the like and subscribe button, that allows us to bring you the very best financial intelligence and the best guests on the planet. Anyway, appreciate it. Like and subscribe.
Welcome back to Real Vision. I'm Dr. Sebastian Purcell, the CEO and CIO of 1.2 Capital Management. Today, I have the pleasure of speaking with Darius Dale, the founder of 42 Macro. So thank you for joining us, Darius.
Sebastian, it's a pleasure, my friend. How you doing? Happy holidays.
Happy holidays to you too. It's an interesting time, kind of cold up here in the Northeast, but
very cold.
Yeah, it is. Good in the markets though. So for our audience, I thought I would start you out with an easy one, help them get to know you a little better or refresh their memories. Just how did you end up in this investment space to begin with? What was your journey? I find that people typically have unusual journeys. So just how did you get here to where you are right now? And what's your view of, as a result of that, of like investing success?
No, look, man, that's appreciate you asking that question because I think I have a very incredibly unique story to where to investing success and where I am in kind of on global Wall Street. I kind of grew up, not kind of, very much did grow up extremely poor. My parents were drug addicts. We were homeless quite a bunch throughout the course of my childhood. So clearly investing was not something that was on any of our minds at any given time. The first 18 years of my life, I had the great fortune of attending Yale and sort of really just by happenstance, I was reading the YDN one day, and a firm, a startup research firm, was put an ad in the YDN, and this is 2008. And I remember remarking to my buddies, like, "Man, these guys are like advertising that they're hiring in the career section," which I thought was hilarious. It was like, these guys are idiots. But then it turns out, like, all my buddies who had interned at all these big major Wall Street internships that summer in 2008, they didn't get offered. And so apparently the global economy and global financial markets are melting down, and this was the only firm in global Wall Street that was hiring. So obviously I applied and got the job, and the rest is history.
Oh, wow. Great. So, all right, I asked you about this a little bit before as we were just chatting before this, but how does that tie into 42 Macro, the name of that, if it does at all?
Yeah, well, look, I mean, I spent, the first 12 years of my career, building a very large and successful, institutional research business. We were quite successful there, and I was the sector head of macro for quite a few years prior to my leaving. And with 42, the concept of 42 Macro kind of comes from this belief. One, I have a tremendous, obviously, amount of respect and admiration for Jackie Robinson. Sort of broke the color barrier in professional sports here in the United States. When I started 42 Macro, it was with the core belief that, I think we can be doing a better job for our clients. Jackie's got this one quote that really resonates with me and stuck with me throughout my entire life, which is, a life is not important except in the impact that it has on other lives. And what I noticed that, at my previous shop, I was sort of making, a lot of my efforts were going to making previously existing rich people rich, whether that be the partners of the firm or the clients of the firm. And I realized that, I was not really having the kind of impact on the global investor community that I would have liked, particularly people that grew up like me, people from Main Street that were on the outside looking in of Wall Street. And so, I left early 2021 to start 42 Macro with the idea that, hey, I can do my job, which is, create, world-class institutional macro risk management frameworks and processes for the world's best investors. And I can actually do that job for Main Street as well. And I think we've been proven over the past 4 years that we've done a fantastic job at that.
Hey, I hope you're enjoying the episode. If you want to dive deeper and really dig into what's going on and how to understand it, then grab my Everything Code PDF for free. Just hit the link in the description below. You're going to love it. I'm sure it's going to really help you.
That resonates with me. That's also one of the key initiatives I had myself, trying to operate in this space. You do worry a little bit about helping out those who are already well off and not helping out the rest. So 100%. I completely resonate with that. So that goes to the question of investing success. You can take that very broadly, but for investors, they'll also think about this in one of two ways. Like, do you use benchmarks to assess yourself? Do you think of yourself like your approach is an absolute sort of investor? You always want to produce a certain amount of returns, absolutely, regardless of conditions. Anyway, so how do you think of investing success, and maybe how do you measure it?
Yeah, no, I think as an investor, that's one of my favorite questions I've ever been asked on any podcast, by the way. So congrats to you, Dr. Purcell, for asking that question, because too many people don't realize what it is that their objectives are. I tell all of our clients, one of the most important things you can do as an investor is to take out a freaking piece of pen and a piece of paper and write down what your strategic investment objective is, and then tape it to the wall somewhere and then leave it there. And so that make sure that it forces investors to remind themselves exactly what it is that I'm trying to accomplish, right? You get so caught up in this theme or that theme, this narrative, that narrative, this trade, that trade, and you forget what it is that you're actually trying to accomplish. And so defining investing success from my perspective is two ways. There's defining investment success for investors on Wall Street, and there's defining investment success for investors on Main Street. And fortuitous that we built two separate processes within the context of what we do to help both of those categories of investors achieve success. So I'll start by the investors on Main Street. We built our, if you saw slide 10, Brian, in our presentation here, we built our systematic KISS portfolio construction process to help investors on Main Street achieve what we believe should be the kind of the mean or median, kind of investment objective of the average investor on Main Street, which is to retire on time and comfortably. And retiring on time and comfortably does not require you to pick factors long and short across asset markets. It does not require you to, be exceptional at timing or predicting or any of this stuff. What it requires you is to extract the beta that the market gives you and to preserve those gains whenever it's time to preserve those gains. That's it.
Yep.
That's exactly what our systematic KISS portfolio construction process does for investors. We do benchmark ourselves against 60-40 in the context of this process. But ultimately, what we're trying to do is generate high risk-adjusted returns that meet a minimum, return threshold that most investors would consider, functional towards the goal of retiring on time and comfortably. And that's exactly what we do here with KISS's average annual return of north of 20%, which compares very favorably to the average annual return of 10% for 60-40, and very just demonstrably outpaces all of our benchmarks relative from a return, from a risk perspective. Max drawdown of 11% versus 22% for 60-40, 25% if you're going to run our KISS process without the benefit of our kind of systematic overlays. So super proud of this. It's done a fantastic job of helping me. I've managed all my liquid net worth with our KISS portfolio construction process. It's done a great job of helping me and thousands of our clients, incrementally move towards retiring on time and comfortably. So Sebastian, that's answer number one. Answer number two comes in the form of our discretionary risk management overlay, which we use to help institutional investors, sort of, I guess, retire on time and comfortably, which means you're helping your clients make money and getting, big bonuses as a function of that. And that process does require, factor long, short bets, which I would argue generating alpha is much harder than just participating in the market beta. And so our discretionary risk management overlay, what we've built is a system that, essentially tells clients at any given time exactly how they should be positioned in any, what we consider to be the 70 core factors across all the different asset classes. And so, just kind of, if we're using this as an example, 94% of the S&P 500 return throughout the lifetime of our out-of-sample back test, which begins in January of 1998, has come when our discretionary risk management overlay has signaled a long position in the stock market. And you can see those types of returns are, consistent across asset classes, consistent across factors as well.
Yeah. Okay. Yeah, no, that makes a lot of sense. I have trepidation talking to just ordinary folk about shorting things myself.
They shouldn't be shorting.
Yeah,
if you're a retail investor and you're shorting stuff, I have no idea why, but you need to invest a lot more time in therapy and hobbies than you do in trying to figure out what the next thing to short is. I think it's just a terrible waste of time if you're trying to retire on time and comfortably. If you're trying to pretend to be a hedge fund manager, then short away. Make your job harder. Go ahead. It's your choice as a human being. But I dare say it's a horrible waste of time for the average retail investor.
Oh yeah, I agree. We have an AI algo that does that for us. It is a complicated process, and that's exactly I get questions about that all the time from people, because sometimes there's that illusion retrospectively of like, oh, if I just shorted it then, but it's never that easy. Never is. You've mentioned, by the way, that you start out sort of looking at your approach begins with a macro focus.
Oh yeah.
And crucial to that are growth and inflation dynamics. So I just kind of wanted you to unpack, well, for me personally, if not for anyone else doing this, um, just, how you think about the component parts of, say, growth or inflation. What are you looking at exactly? And I'll have some follow-on questions about what you don't look at, which is probably equally important for people because macroeconomics there are a lot of facets to it, and you can get lost in the noise if you look at too many things.
Well, it's mostly noise. Most of the information that we're consuming is noise. By the way, I don't think the average investor realizes that. You have to extract signal from the noise as an investor in order to have a robust and durable investment framework. And obviously, that's what we get paid to do for our clients here at 42 Macro. So I think we have invented quite a good mousetrap that continues to evolve and get better over time. I'll kind of modify something you said earlier. You say you have an investment process that starts with growth and inflation, and I would disagree. Our investment process sort of starts with understanding what the market is trying to price in and participating in that. Brian, if you throw up slide 5 where we show our macro risk management process here, that's kind of that's what we get paid to do for our clients. We help them identify and position for the market regime through the lens of our global macro risk matrix. That's our market regime nowcasting process, and then our KISS portfolio construction process we talked about earlier, and our discretionary risk management overlay, aka Dr. Mo. We talked about those earlier as well. Those are the two offshoots of positioning for the market regime. The global macro risk matrix helps you identify what the market's trying to price in, whether it be Goldilocks, reflation, inflation, and deflation. And each of those 4 different market regimes has a whole set of specific factor, long, short pivots that you need to make as an investor in order to remain on the right side of market risk. So, for example, if you go from risk off inflation to risk on reflation, then you got to make this change and that change and this change in order to remain on the right side of market risk. So the primary thing we do for our clients is help them time those pivots through the lens of our quantitative risk management signaling. Everything else I say, and most of what we're going to talk about today, has no bearing on the positions that our clients are being instructed to take from an asset allocation or portfolio construction standpoint. Everything else we say, whether it be where growth is headed, where's inflation headed, where's liquidity headed, where profits headed, where are we at in the positioning cycle. Everything else we say is to help clients generate some emotion, some high degree of emotional confidence associated with where we are in the current market cycle and where we might be over the medium term time horizon. That's it. We're just trying to help them build and erode confidence in what the systems are currently signaling, what they might be signaling at some point in the near to medium term future. So that's it.
So I want to pick up on a point that you made there. If I heard you correctly, you said something along the lines of there are 4 quadrants or something. That's almost what I envisioned with like growth and inflation. Like
4 regimes.
Four regimes. Could you unpack that a little bit?
Yeah, absolutely. So Goldilocks situation, that's risk on with the disinflationary bias. So obviously it's a risk on regime. It's typically the regime that has the highest concentration of the positive performance in most risk assets. Typically risk assets go up the most. When you go back and back test the stuff when you're in Goldilocks. Followed by reflation. That's a risk on regime where the market is pricing in an inflationary bias. So you have things like interest rates rising, et cetera, commodity prices rising, et cetera. And then you have the 2 risk off regimes are inflation, which is risk off with an inflationary bias, and then deflation, which is risk off with a disinflationary bias. So, you could think of, Goldilocks being the opposite of inflation and reflation being the opposite of deflation. And so, based on our, careful back testing and understanding of these sort of intermarket dynamics, we understand exactly the pivots you need to make as an investor when you're going from regime A to regime B. Generally speaking, when you're going from Goldilocks to reflation or reflation to Goldilocks, there are no pivots to make, with the exception of, your exposure to duration in the bond market. When you go from, risk on to risk off and risk off to risk on, there typically are several pivots you need to make from an asset allocation and portfolio construction perspective, which are, obviously being communicated asset allocation wise via KISS, our KISS portfolio construction process, or from a portfolio construction standpoint vis-a-vis our discretionary risk management overlay, aka Dr. Mo.
Okay. So so you do have the 4 dynamics there. And so I did want to touch on some things that I don't hear you talking about. Please correct me if this is not accurate. But again, this is about finding the signal in the noise. So not paying attention to things matters as much as paying attention to things, maybe more. I didn't hear you saying, for example, that you spend a lot of time worrying about, I don't know, liquidity measures, which would typically be what people are worried about for the Fed. That's kind of a complicated measure because sometimes that is inflationary based and you would care about that. And I don't hear you talking too much about credit risk cycles. Um, Is that right for your review, that those are not really going to be important factors in your outlook, like liquidity moving into the space or credit cycle? Those are not things that you're looking at, or how do you position yourself with respect to those?
No, great question. Look, I quite frankly, I think you heard what you wanted to hear there. We
Okay.
definitely, I think, and I don't mince words about this. When it comes to the sell side, I am definitely one of the top 5 people in the world when it comes to the topic of liquidity. I mince no
Okay.
words about
Okay.
that. If anyone has a different view on that,
Okay.
definitely I'll invite me to a debate and I'll smoke you. So yeah, we definitely care about those things. From our perspective, there's sort of 6 cycles that really matter
Okay.
when it comes to getting asset markets right. And again, I'll start by saying we don't use any of this information to help our clients position in their portfolios. We use this information to help them anticipate how the signals that we send them to position their portfolios might evolve over the short to medium time horizon. So going back to the 6 cycles, there's growth, there's inflation, there's policy, there's corporate profits, there's liquidity, and there's positioning. And you have to have a very informed, detailed view of where you are in each of those cycles at any given time if you want to have confidence or have a higher or low amount of confidence in the sustainability of the current market regime. Anyone can pull up a chart and figure out, okay, what are markets priced again? We're in a raging bull market in crypto, raging bull market in stocks, credit spreads are low, valuations are high. It's probably a risk-on regime. All right. Like whether it's reflation or Goldilocks, that's, it's hard to determine that if you were just kind of looking at markets, but we can determine if we're in a risk-on regime. How you develop confidence in the sustainability of the current market regime and start to build confidence in what that market regime might evolve into over different time horizons is through the lens of those 6 cycles. And so we definitely have a tremendous amount of research, high-end institutional research performed on each of those cycles at any given time. And so, we can unpack, where we think we are in any one of them, but I certainly I don't want to mince any words. We are very good at understanding where we are in those cycles, but those cycles don't determine what our clients feel in their portfolios.
Okay.
Our systematic system signals do.
Okay, so there's the portfolio and then the assessment of where you are in these broader cycles. Okay, so there's 2 components to this, and that's sort of what I wanted to tease out of that. Then, given that, I think I have a puzzle that may be useful if we can switch to that one. I think it's my first slide up there. This is a macro puzzle, if you will.
Let's do it.
What we're looking at there is, and maybe a little hard to read on the screen, but a quote from the lead economic indicator, which declined in 0.4% in October. That follows a 0.3% in September. Over the 6-month period between April and October, the LEI fell 2.2%, slightly more than its 2% decline over the previous 6-month period. So that's from the Conference Board Lead Economic Indicator Index. That would suggest that it's not a super great regime, that somehow the fundamentals of the market are deteriorating. On the other hand, we have the National Financial Conditions Index put up by the Chicago Fed. This is a 105 component index for free. People, you can just go there. Currently, it stands at a negative 0.64. It measures the liquidity in the market. The more negative that gets, the kind of more, the looser the financial conditions are, the more positive that gets, the more constrained they are. There's a little bump on the screen just after 2020. That was COVID. Obviously, financial conditions were tight at that time. COVID era low after Jerome Powell, the Fed, printed a lot of money. That's an oversimplification, but put a lot of money into the system. The COVID era low was negative 0.69. So we're at a negative 0.64 right now, almost as unconstrained and loose as that period of time, which would seem to suggest it's a great time to invest. Just sort of throw your money in an index and you're done. So one of these indicators suggests decline. The other indicator suggests growth. What's going on here? Can you give us your view of this?
Yeah, no, it's a phenomenal question. So I think it's very important to understand, it's really important as an investor to understand which indicators are noise and which indicators are signal. And more importantly, to what degree are they signal? Some indicators produce more signal, some indicators produce less signal. Some indicators are more noise, some indicators are less noise. So for something like the LEI, we find it to be more in the noise category. Specifically as it relates to the U.S. economy. And again, I don't mean this pejorative, but just based on our own back testing and our own understanding of financial markets. People can have a different view on this, but our view on this, and part of the reason why the average investor just completely whiffed and missed, including all the top smart minds on global Wall Street, completely whiffed on the resiliency of the U.S. economy, which is a theme we authored in September of 2022. Right, one of the 6 pillars that are upholding that theme, and it's been true since then, remains true today, is that the U.S. economy has very limited exposure to the volatile manufacturing sector. If you go slide 25 up, Brian, where we show manufacturing share of nominal GDP at 10%, from a peak of 28% back in the 1950s, and then you have manufacturing share of total non-farm payrolls at only 14% from a peak of 44% in the 1940s. This is an economy that just has very limited exposure to the manufacturing sector, which matters a lot from the perspective of forecasting where the economy's headed, because the manufacturing sector is the cyclical sector in the economy. It is the sector that goes into recession and comes out of recession. The services sector, which is largely driven by population growth and migration, does not ever contract, hardly ever contracts. And so you think about this, if you kind of throw a statistic out there for you, the manufacturing sector has accounted for a median 98% of net job losses in the 12 post-war U.S. recessions. 98% of the job losses we experience in recession come from the manufacturing sector. And so if you understand that we have a limited exposure to the manufacturing sector, then you would have had more confidence, like we did, to get rid of things like the LEI, which doesn't have a lot of signal. It has a lot of noise, especially in this particular business cycle. So that's kind of one starting point to think about this. Another starting point to think about this is, kind of through the context of, where's liquidity? Where is liquidity?
Right, yeah.
We kind of have a, modest, so I'll start, if you look at slide 56, one of the things we do, we track liquidity quite religiously here at 42 Macro, and, both from the perspective of every major economy in the world, but we also tally that up in terms of our global liquidity proxy. And our global liquidity proxy, which is the aggregated sum of the central bank balance sheets from all the world's major economies, their broad money supply from all their economies, and then all their FX reserves minus gold. And then we layer on a bond market volatility overlay to simulate the impact of the contraction and expansion of the repo market cycle. And so one of the things we found is through this analysis is that asset markets are co-integrated with global liquidity. Liquidity's high and rising, you tend to see high and rising asset prices and vice versa. And so we understand based on having created this empirical analysis, we can then figure out what leads global liquidity over the medium term. It's things like the global equity market cap, global crypto market cap, the dollar, FX volatility, it's interest rates, it's fixed income volatility, it's global growth, it's global inflation, and global employment. It's really just those metrics from all the major economies of the world, but obviously aggregated on a global basis. And when you kind of get to the punchline on all that, when we look at where we are today, the model is currently suggesting that we should have a modest increase in global liquidity over the medium term when you look at the current spread between where these indicators are on a weighted basis relative to where the growth rate of liquidity is. It's suggesting that the growth rate of liquidity needs to catch up a little bit over the medium term. So answer your question. I know this is a long way to answer your question. When we sort of, going back to your question, it's really just a function of, where are we in the liquidity cycle? Where are we likely to be in the liquidity cycle? Where are we in the growth cycle? Where are we likely to be in the growth cycle? That's the question I heard, as opposed to, the sort of the way you characterized it, which is, right now we're in from a U.S. perspective, we're kind of at the top of the growth sine curve looking down, but, not looking down at a significantly sharp deceleration unless we get, significant acceleration in tariffs, et cetera, which is obviously not something you can predict. You just have to respond to it as an investor. And then from the perspective of liquidity, things are good and should be getting slightly better over the medium term. But there are obviously some headwinds on the horizon that could change that.
Yeah. So, the National Financial Conditions Index quasi measure, it's sort of, that's a backwards looking view. Probably the FOMC minutes on December 18th concludes on the 18th will maybe tell us whether or not, the Fed is going to stop QT in a certain way, which would certainly help for liquidity factors. So that's a good point. I didn't know that about the manufacturing sector, and that does explain why the LEI is sort of doing its own strange thing. It does bring me to this question. You partly broached it, but I wanted to see what you thought about this. I have a slide here, which I'm going to move forward really quickly. It's another little puzzle. I like these. Those super informative. So here's our second puzzle, which I think the viewers.
Oh, this is a fun way to do an interview. Like, okay, here's this puzzle. Let's unpack the puzzle.
Let's unpack the puzzles. So horseshoe politics. The idea behind horseshoe politics is that if you go, like you're holding two edges of a horseshoe, you go, eventually they connect at some point, right? So if you go far enough left or far enough right, you get political figures who seem to overlap on strange topics. So Bernie Sanders, well known, progressive liberal, stated in 2019 that, quote, since the China trade deal I voted against, America has lost over 3 million manufacturing jobs. It's wrong to pretend that China isn't one of our major economic competitors. So he would like to reshore more manufacturing jobs. Trump has said very similar things. In addition to proposing tariffs in a campaign speech, Trump proposed, quote, a 15% corporate tax rate, reduced regulations, and access to federal land and port infrastructure if companies hire American workers. So again, he's trying to reshore specifically the manufacturing sector. And this goes right to this question that we just had about the lead economic indicator and whether or not that's useful. What do you make of this strange agreement between Bernie Sanders and Donald Trump? Obviously, on the deck are more tariffs as a way to incentivize reshoring. So those are two things. I guess the one question there is the goal. Do we even want to re-incentivize that? And what's the likely outcome for that? But we'll start with the first question. Like, what do you make of that strange overlap? Um, and then what does that mean for sort of the macroeconomic landscape?
Yeah, excellent question, Sebastian. So I'll start by saying we're in a fourth turning. For those who may not be familiar, the fourth turning is a sort of generational frame. It's a geopolitical framework that essentially argues that there are four generational archetypes. When they align in a certain way, you typically have a significant amount of sort of change, institutional change, if you will. With respect to political alignments, with respect to breaking down and building up of new, old and new institutions, you typically have total war in these fourth turning instances. My former colleague and one of my mentors, Neil Howe, created this framework with his late colleague Bill Strauss back in the late '90s. And quite frankly, I mean, you could say outside of like the Bible, I've never read a book that became more true as time went on, right? And so, this is a framework that we have a lot of confidence in, both again as someone who's been trained by Neil Howe, but also someone who has done a tremendous amount of empirical research on this particular topic ourselves here at 42 Macro to determine one, codify Neil's work, and two, to kind of expand on it from the perspective of an investor. I don't think Neil focuses too much on that as an investor. And so, one of the things that we found one of the things Neil found in his research of these sort of Anglo-American fourth turnings, of which there have been, I want to say 5 or 6, going back to the 1400s, you typically have significant political realignment in these generational periods. And Neil would certainly argue and has argued that the first regeneracy of this fourth turning kind of came when the Donald Trump sort of realigned the Republican Party with kind of the populist, formerly populist wing of the Democrat Party. And you can kind of see this when you look at some of the policy proposals that he's proposed on the campaign trail and implemented, one in his first administration, but certainly proposed on the campaign trail on the second administration. We throw a slide 99 up here, Brian, where we show President Trump's the Committee for Responsible Federal Budget sort of looked at the policy proposals that Vice President Harris was bandying about on the campaign trail, as well as the policy proposals that President Trump was bandying about. And what we saw is that there was a tremendous amount of overlap between the two of them. Right, the Republican Party under Trump is a lot more left economically than the old Republican Party, that the one we're used to with Mitch McConnell and Paul Ryan and Mitt Romney. That Republican Party is essentially dead, for lack of a better word. And so I'm not at all surprised to see Donald Trump and other pockets of the Republican Party coalesce around this sort of idea of reshoring and populism, as kind of core features of the party. Because again, we are in a fourth turning. This is when you typically see political realignment in Anglo-American history. And kind of throwing a bow on this, a couple points I'll make. The first point is, the President Trump is, I would argue, is arguably the most populist president since FDR. right? If you just look at what he's promising people, he's not going to get everything he promised to people, but we're going to get some version of that, and it's a lot of stuff. The Committee for Responsible Federal Budget essentially said in their conservative estimates, he's essentially threatening to add about $7.5 trillion to the U.S. public debt on top of a baseline that has the U.S. public debt accelerating to 125% of GDP by 2035. If you add everything up that he promised on the campaign trail, according to their conservative estimates, it'd be somewhere around close to 142% by the end of this decade projection period. So starting point one is, okay, we're now dealing with a populist president under the guise of the Republican Party. But again, the Republican Party is clothing. It's a flag. It's not a ideology set. The ideology set is morphing in real time according to the demands of the population, which brings me to my second point. The demands of the population are demanding populism. We said this in August. We said no matter who, it doesn't matter. Whichever candidate promises the most free stuff to people is going to win the election. We said this in August, and that's exactly what happened. And the reason we said that is because the conditions are ripe for populism here in the United States of America. If you look at this chart here on slide 94, Brian, we show labor's share of national income versus corporate profits, capital share of national income vis-a-vis corporate profits. So if you look at nominal employee compensation divided by gross domestic income, we're down at 52% currently versus a mean of 56% from 1960 all the way through 2000. And if you look at corporate U.S. corporate profits as a percent of gross domestic income, we're at 13% currently, essentially an all-time high there versus an all-time low in labor share. And that 13% compares to a mean of only 9% from 1960 to 2000. And so that 400 basis point swing in income that used to go to the household sector that now goes to the corporate sector doesn't seem like a lot, 400 basis points, whatever, whoop-de-doo. But the reality is, if you look at it relative to the latest data, you're talking about a $1.2 trillion per annum swing in income that is going from the household sector to the corporate sector. It's essentially a regressive tax of the U.S. public policy that has shipped all of our jobs to China vis-a-vis joining the WTO in 2001, vis-a-vis to Mexico, vis-a-vis NAFTA in 1993. We've shipped a lot of our jobs to these economies, and ultimately that policy has caused a significant income redistribution and ultimately wealth redistribution here in the United States of America. That $1.2 trillion, Sebastian, that's essentially roughly just shy of $9,000 of lost annualized income per private sector employee. It's roughly 11% of the median household income. So you're talking about losing double-digit share of your income annually as a person in the United States of America relative to where you were, kind of at the turn of this century, 24 years ago. So this, in my opinion, is one of the most important charts that macro has been for years now. And ultimately, the only way out of this situation, well, there are multiple ways out of the situation, but the game theory way out, the route that probably requires the least amount of pain soonest, is the route that required that populism is the answer to that equation up until the point where we reach the point of no return from a fiscal crisis perspective. That's a separate conversation.
Completely separate conversation. Yes, the sort of Damocles is hanging, right? But that is a different conversation for sure. Totally. I find that very interesting. And you're right; it does make sense why we would get obviously Bernie Sanders and Trump are both populist sorts of politicians, and that's
if you want to win an election here, you got to promise people stuff. That's it. It just is what it is. That's what this chart requires. This chart requires an income and wealth redistribution, and the only way you can redistribute income and wealth is by changing fiscal policy. That you have to change fiscal policy. You probably have to change monetary policy too as well. But again, this is going to be a multi-year, kind of decade-long process to getting these lines back in appropriate order. It's going to require a lot of hardship, a lot of sacrifice, and potentially a total war, which is pretty consistent in these four turnings as well.
Right. So, and the prospect then, to your mind, of reshoring manufacturing jobs, I guess there's that buried question there. It has provided us with a certain amount of, immunity from market cycle forces, but we have this idea of returning them. Does that even seem like a viable idea for you? The thing that these politicians are campaigning on.
Reshoring manufacturing jobs?
Yeah, reshoring them. Yeah, especially as incentivized through tariffs.
Well, I mean, what it ultimately means is that we're going to knock the red line down in the most recent chart, slide 94 again. Yeah. The corporate profits to GDP, to gross domestic income plot. that number is going to be forced down. What it ultimately means.
Okay.
The Republican dogma will be the dogma that it tells you we're going to grow our way out of everything and everything will be fine. So don't worry about the line going down or don't worry about the going up. We're going to grow our way out of everything. But we're smart enough to know that that's misguided dogma. And before I get attacked on Twitter for saying that, the reason I can say these types of things without any concern about how I'm going to be labeled as a macro risk manager is I wear a red and blue tie, I wear purple. I'm not part of any politically compromised political party. I'm not a Republican. I'm not a Democrat. That's your guys' problem. Our problem is trying to figure out what the data tells us. And going back and doing deep dive econometric studies on everything we do and say here at 42 Macro, what we found is that look, there's really no difference between a Republican administration and a Democrat administration from the perspective of saddling and burdening the country with tons and tons of debt.
Right.
So you go back and you look at the cumulative growth of U.S. public debt here on slide 96, Brian, of U.S. public debt during presidential administrations. When you look at the median in the post-war era, so kind of excluding at World War II and World War One, starting with the post-war era with our friend Harry Truman, Eisenhower or Harry Truman too. So if you look at the median growth rate of U.S. public debt after year one, Democrat median is about 7%. The Republican president administration median is about plus 2%. Democrat median after 2 years is plus 8%. The Republican median after 2 years is 8. Sorry, Democrat median is 12% after 2 years. Republican median is 8% after 2 years. The Democrat median after 3 years is plus 22%. The Republican median. Oh, sorry, I'm looking at the wrong statistics. My apologies. Let me start that over. My apologies. Post-war. So the Democrat median post-war after year one is plus 6%. The Republican median at post-war for Republican median is 5%. The Democrat median post-war after year two is 10% versus 12% for Republicans. The Democrat median after year three in post-war U.S. economy is plus 22% versus 21% for Republican presidents, administrations. And then finally, if you want to look at it on a cumulative basis, year four, the Democrat median growth of public sector debt is 26% after year four and 39% for the Republican presidents on a median basis after year four. And so if you want to exclude President Trump's experience with COVID in 2020, the Republican median is still 36%. In fact, if you look at slide 97 here, 7 of the top 9 U.S. presidential administrations in the post-war U.S. economy that in terms of growing the public sector debt have been Republican administrations. Number one is Ronald Reagan's first term at plus 79% growth. He grew the public sector debt by 79% in his first administration. Number two is Ronald Reagan, his second administration. He grew public sector debt by 56% in his second administration, then followed by George Bush, George H.W. Bush at 56%, Barack Obama at plus 54%, Jimmy Carter at 42%, George W. Bush at 41%, Gerald Ford at 39%, Donald Trump at 39%, and George W. Bush at 32%. Again, 7 of the top 9 growth rates of public sector debt in U.S. presidential administrations in the post-war U.S. economy have come from Republican administrations. So unfortunately for some folks who are listening to this, we at 42 Macro, our clients who've been outperforming for the better part of 3.5 years now since we launched the firm, we don't buy into the Democrat dogma. We don't buy into the Republican dogma that tells you we're going to grow our way out of all this debt with tax cuts and deregulation. All that's nonsense that's designed to get money in the hands of the elites, more money in the hands of the elites at the expense of Main Street. And I'm here to try to do my best to stop it.
Yeah, all right. No, and that's illuminating and very clear data.
People hate data like this, Sebastian. It challenges their core belief system. They hate it. Right. They hate it. I've had clients yell at me because of publishing this information. Well, you don't get it. You don't get it. The data's a lie. All the data's a lie. My dogma is correct. My Fox News dogma is correct. My MSNBC dogma is correct. That's these people. If that's you, take that and do something else with it. But for the rest of us who are here trying to solve society's problems and make money and save money in financial markets so that we can retire on time and comfortably, or help our clients retire on time and comfortably, 42 Macro is a research provider for you because we're always going to be truthful, in terms of shedding light on these types of issues.
Yeah. So no, that makes a lot of sense. I think that you're right. On our own side, I think you have to, as an investor, sort of take a editorial neutrality and just assess the data as it is. It's better to understand what's coming at you in any case than to not understand it and hope blindly. But it shows that there is a sort of strange, I don't know, policy alignment that's been in the work for quite a few decades. It does bring us to another feature of perhaps the changing world order, which is maybe the background theme for a lot of our discussion right now.
Oh yeah.
And I just kind of wanted to ask you quickly about, because this has shown up, I did a quick review this morning. What is showing up in, the news channels, et cetera? And the war in Ukraine with Russia is still top of mind. Myself, whenever I go to this, I sort of think the impacts to the United States market are not immediate, but I did want to highlight a few points and get your take on it at least, because it, I don't know, potentially suggests a further realignment of what we consider Europe and the West, et cetera. So on my slides here, just to kind of focus us, I have one slide that I think would be of interest to you.
Yeah, please.
What we have is Ukraine and Russia. Potential impact here is on commodity pricing. Ukraine, of course, had a lot of wheat, right? And wheat is something that in a sort of warming global world we've pushed it. It's sort of a weed and we grow it in weird places because we can, but we're eventually going to have to grow it in better places than we are right now. So that's sort of a long-term effect. There's supply chain shocks, especially in Europe, and geopolitical stability right now is changing. I think that's the safe thing to say, is that it's changing. Russia did not actually use intercontinental ballistic missiles against Ukraine. That was a false report. Apparently, they just used an intermediate term missile, which really is more impactful for the European era for signaling effectively, as I'm reading it, that the detente that Europe had about not shooting each other is sort of up for grabs, is something negotiable right now with Russia. So my view of this, since a lot of my own focus is on the US market, is how impactful that is for us. I tend to center on the US market, not simply because I'm an American, but also because we tend to have a pretty resilient economy. So, how impactful do you think any of this will be for us, or is it something that is further down the road and is really just a European? Because there's an isolationist tendency right now. In the United States? Is that more of a European focus, and it'll be left over there at least for a few years, or not? Like, what exactly do we do with this? Because we get news about it effectively every day.
Yeah, 100%. So, like I said, all news is not signal. Most news is noise, and
Yeah,
so you must, as an investor, understand that no more at any given day than 10% of the information you consume is going to be signal. I would say 10% is probably very high.
generous,
Signal.
generous.
It's incredibly generous. It's probably close to 1% on most days. Even as someone who publishes research daily, not most days there's not much to talk about.
Yep.
So that I digress. But so to answer this question, I think it really goes back to understanding where you are in those 6 cycles: growth, inflation, policy, profits, liquidity, and positioning. If you can tie wars and the sort of the underpinnings of war, the changes in commodity demand, or geopolitical friction, trade tensions, et cetera, if you can tie those things back to causing a significant reversal in momentum or change in inflection where you are in one of those 6 cycles, then it will have an impact on asset markets. Most of the time, headlines of war do not. Right, some of the most raging bull markets of all time have come during wars, and so investors need to be quite aware of that, acutely aware of that. Brian, if you throw slide 40 up, so we're showing a little bit of the analysis that we, showed our clients on a regular basis here at 42 Macro. We are investing during a fourth turning regime, presentation. We have that as an appendix to our monthly macro scouting report presentations. And it's about, 50, 60 slides of, deep dive empirical research on some of these big topics like war, et cetera, fiscal crisis, et cetera, that may eventually have a significant influence over asset markets and the economy, and policymakers' responses to those things over the long term. And one of the things we show is that wars tend to accelerate globally during fourth turnings. You go back and you look at the last few fourth turnings. We had the Civil War, we had the World War II, and obviously we have Russia, Ukraine, Israel, Hamas, and ultimately, one of the things that Neil found in his research, in his fourth turning research, is that when you're in these fourth turnings, they always sort of coincide with total war, right? There's enough sort of demand for institutional change in the system, for in these four turnings, that almost kind of requires a war in order for that change to go about. Because right, people don't give up rights and land willingly to the people who
Right.
knock on the door politely and ask for them. They give up things like civil rights and freedom from slavery and things like that. You got to pry that stuff out of their cold dead hands typically.
Yeah.
And so when you think about this from a fourth turning perspective, you go backwards in time. The previous fourth turning was the Great Depression and World War II. The prior fourth turning was the Civil War. The prior fourth turning was the American Revolution. The prior fourth turning was the Glorious Revolution. The prior fourth turning was Armada Crisis, and the fourth turning before that was the War of Roses. And that's kind of where the research, stops going backwards. But I'm sure Neil can keep going backwards if he had time, and probably will at some point in the future if and it becomes very clear that the U.S. is on a marching path towards a global war, total war. So, the key takeaway is that eventually we're probably going to have a total war in this fourth turning. I hope we don't. There's no guarantee we will, but there may very well be a total war here in this fourth turning. And obviously that will require a complete mobilization of public sector resources. And if we have a complete mobilization of public sector resources, going back to what we talked about earlier on slide 99, where we showed the U.S.'s debt to GDP ratio was already going to be, 125% under current law, without any of the, extension of Trump's tax cuts and all the other, free stuff that Trump promised on the campaign trail this summer and this fall. We're talking about potentially being at 125 to 142% of GDP of sovereign debt before we have to completely mobilize public sector resources and add another, let's call it 5,000, 50,000 basis points of potential, not 50,000, 5,000 basis points of debt to GDP to the U.S.'s, fiscal coffers. So that's a long-winded way of answering your question. But again, this stuff can and eventually will matter. If it even is not a total war, the fourth turning regime that we're currently in does necessitate a complete mobilization of public sector resources towards the end of this process in order to actually have imagine if you went from a very complicated, Rubik's Cube where all the colors all over the place. Eventually, what the fourth turning is somebody comes along, breaks the darn Rubik's Cube, and then picks it back together and puts all the pieces appropriately together, right? Instead of trying to, spin it around for the next, 6 weeks. So that's sort of what a fourth turning is. And eventually, if you believe that is the highest probability outcome, the breaking of the Rubik's Cube and putting it back together, that will require the breaking of the Rubik's Cube. That is the mobilization of public sector resources. So whether it's a war, whether it's a pop fist, there's a comet coming between the Earth and the Moon in 2029. It may actually hit the Earth. Who knows? I don't know what they tell us and don't tell us. It could be a global climate crisis, that causes a huge net migration internationally. I don't know what the answer is, but we do know that the U.S. public sector debt is going to accelerate significantly relative to current law, relative to any aggressive projections for the growth rate of U.S. public sector debt. And it's going to require some difficult sacrifices at the end of that rainbow. But at the beginning of that rainbow, which is why we're so bullish structurally, is the Fed's probably going to be called upon to finance a lot of it at the beginning of the process.
Right. Yeah. So in near term, interesting, like liquidity inflow, how we pay the bill at the end is the question.
With monetary debasement, financial repression, and inflation.
There are only so many tools, and historically, we kind of know what those look like, right?
Bingo. Exactly.
Not exactly a pretty item in the long term. That did bring me to sort of wrap up in a way. I kind of wanted to ask you about just directly actionable items that people can think about in this sort of environment, because there are many things that are happening, and just as an example of what I had in mind. Well, okay, so if you worry about the outbreak of war, there are some stocks that tend to do well because they produce the materials needed for that war, and it's increasing. Their top line is definitely going to go up if nothing else does, even if they're terrible at operations. So, which, Northrop Grumman or Lockheed Martin would be sort of examples of that, perhaps. But I don't know. So that's like one example of, okay, if you're betting on that, if you're betting on, I don't know, public sector debt increase, is there an obvious sort of way in which things tend to go? I don't know if you can. So that's what I'm looking at. Is by way of wrapping it up for just our viewers, is there some sense about where things could go concretely?
Yeah, 100%. Very much so. It's sort of weaved into our systematic KISS portfolio construction process, which is, again, that 60-30-10 trend following strategy that we use we help retail investors, run their portfolios, towards retiring on time and comfortably. And already as a core feature of that 60-30-10 strategy is an admission that the bond market is ultimately the ultimate source of risk over the long term. In our view, we don't believe that treasury bonds are going to be a good capital appreciation asset over the long term. On a nominal basis, and most likely on a real basis, will probably cause you to lose money over the long term. And so, one of the ways around that, in terms of how we solve the problem for our clients at 42 Macro, is an understanding that we don't want to have 40% of our portfolio sitting around in the treasury bond market. That sounds crazy to me. So, in terms of our 60-30-10 trend following approach, we sold slide 11. We show our current KISS portfolio construction right now, Brian. We are currently at so SPY is the vehicle we use to manage equity exposure. IAU is the vehicle we use to manage our gold exposure. That's a maximum of 30% of the exposure. And then FBTC is the ETF that we use to manage the Bitcoin exposure. That's at a maximum of 10%. And so right now, KISS is fully invested. Again, this is a completely systematic process. It's a trend following process that uses our market regime nowcasting process to incorporate vol targeting on the strategy. And it uses our volatility just momentum signal to incorporate dynamic position sizing on each of these positions. And right now, those two, top down and bottom up risk management overlays have us fully invested. So we're at 100% of our maximum exposure of 60% on SPY. We're at 100% of our maximum exposure of 30% in IAU. And we're 100% of our maximum exposure of 10% in FBTC and Bitcoin. And so the allocations will change over time as we get different signals to our systematic process. But the core exposures of stocks, gold, and Bitcoin, in our opinion, that is set up to help you survive what is likely to be a extended period of time of above trend public sector debt growth that ultimately forces the Federal Reserve to incrementally acknowledge the fiscal dominance regime that we're in by accelerating monetary debasement, by accelerating financial oppression. And that's if we're right on that core fundamental belief, then a 60-30-10 stocks, gold, Bitcoin portfolio will be among the best risk-adjusted ways in which you can participate in financial markets, under the guise of trying to retire on time and comfortably. And obviously, answering this question is very different for institutional investors. But I would imagine that institutional investors, have different asset classes and different things that they can trade in, which we use our discretionary risk management overlay to help them do that.
So that is super helpful in a way, because I think that does address the concern about inflation in a real way. Yeah, bonds are, especially U.S. Treasury bonds, longer term, look to be on the I don't know. To mention something that came up in our pre-discussion. This is my at sixes and sevens, the British expression. Sorry, this is my background from my father. They're not in a good place. They're not in a good place over the longer term, given the sort of broader term focus of the market, and whether or not we get tariffs, which would, I guess, cause inflation sooner rather than later. The expectation is there for difficulty. So that's actually quite helpful for people. And I've really enjoyed this discussion. We've gone from everything about noise and what tends to matter in the marketplace to, potential for war, their effects on things, the need to avoid partisanship in order to be a level-headed investor, and sort of a sense about why the traditional 60-40 portfolio that is just the standard advice is likely, I think this is a real takeaway for people, is likely to not perform as it has in the past and will really underserve people who just walk forward with the conventional wisdom. In a changing environment, we've spoken a lot about the fourth turning. In a changing environment, the traditional wisdom of the past tends not to be helpful, and you have to adapt. So this has all been extremely useful, I think, for our viewers. I learned a lot. So thank you, Darius.
Yeah, Sebastian, I appreciate you, man. You said something I think is very important to end on, which is, we're in a period of great change. And we haven't even talked about AI, which is technological change, right? We haven't talked about AI, which, we can unpack in some future discussion. But, we're already going to be in a period of great change from an institutional standpoint. Something as simple and innocuous as, okay, the independence of the Federal Reserve is an institution that may change in this fourth turning. Investors need to be aware of that. So those are the kinds of things you would expect to see change over the course of a fourth turning. And the real key takeaway is that, as an investor, when there's a lot of change, particularly big change, you have to accept the fact that yesterday's, regimes and yesterday's data points and yesterday's analysis may not equip you with the best possible information as it relates to surviving all that change appropriately and profiting from that change as an investor. And so to me, I think the most important thing you can do as an investor to make sure that you as a retail investor are retiring on time and comfortably, or that you as an institutional investor are helping your clients retire on time and comfortably, is acknowledging that you are never going to have all the answers in a period of great change. What's more appropriate is to figure out, in our view, in our humble view, and again, I think it requires an incredible amount of humility to accept the fact that the market is smarter than us. The market knows more than us. The market will always be smarter and always know more. And so this goes back to where we started the conversation, which is all of our asset allocation and portfolio construction recommendations that we make to our clients here at 42 Macro come through the lens of our trend following the elements of our process, whether it be trend following, 42 different markets on a daily basis to identify what the current market regime is, or there be trend following each of the individual exposures that we feature in our KISS portfolio construction process or discretionary risk management overlay process to determine, what their appropriate weights and it should be at any given time. To me, that is going to set you up to have a more defensible, a higher risk adjusted path to success than what I think of most investors are doing, which is trying to predict all this stuff. I mean, good Lord, I worked at 75, 80 hours a week trying to predict all this stuff and, have, reasonable amount of success. If you're haircutting that by, 175th or 180th as a retail investor, God help you. You're not doing this very well. And so investors need to have, if I can leave everybody with one comment, is to force more humility into your investment process if you want to survive the next, 10 plus years of this fourth turning, well. If you want to invest well and have good outcomes in your portfolio, you're going to have to force yourself to participate more in what the market is trying to price in, as opposed to positioning for whatever narrative or story you've constructed in your head that must come true for your positions to work. To me, I think that's just an objectively worse way to invest, particularly in a time of great, institutional change in the U.S. and global economy.
Yeah, no, that makes it. It's a good note to end on humility, because things are changing so quickly. So being aware of that and being willing to, I don't know, do unconventional things. 10% to Bitcoin. I'm sure that's going to get some viewers, but
I get chirped that it's not high enough from a lot of folks, but it is what it is.
Yeah, I know. Still, it's a new thing. So it's a new thing. Interesting new portfolio construction. And I just want to say thank you, Darius. Thank you to all the viewers for sticking with us on this one. I hope you learned a lot. I did. And so to everyone out there watching, thanks. And we will see you in the next one of these.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.